Yeah, hello, welcome back to the channel. This is another part of the lecture on inheritance tax. And now let's turn to the genuinely international cases. What it's all about is Chapter 3 here, Common Rules for the Avoidance of Double Taxation in Inheritance Tax Cases, and especially the problems for the application of the credit method. Well, we have, if we want to have a small overview, then we have especially three problems. First, we want to talk about the credit method, but if more than two states are involved, let's say three states, and we apply the credit method, then the question is naturally who has to apply or who has to grant a credit for the tax of which other state. We know that usually the source state gets the first, let's call it bite, the first right to tax, and that other state will credit. But if there are two other states, which of them takes prevalence? That's the question. Then another question is usually the credit method requires that a tax credit is given for foreign taxes on foreign property. No state really gives a credit when for foreign taxes on his, or better, its own inland property. So the important thing is now what property is regarded as foreign and which one is regarded as inland property, so that you do not get a credit under normal circumstances. And the last problem is if you give a credit for foreign taxes on foreign property, then that credit is always limited to the amount which would be due under the law of the inland for that foreign property. So the inland lowers its own tax claim on that part of the property to zero, but not below zero. And that means you need to be able to calculate which part of the total inheritance tax, which comes out when you compute the inheritance tax for all the property which was transferred worldwide, which part of that total tax refers to that specific item in a foreign state. And there are several ways how that could be done, and they have different economic consequences, so this is a problem. So let's begin at the beginning. Why is the structure of the double taxation problem more complex in cases of inheritance tax than in cases of income tax or corporation tax, with which you are, at least I hope, already familiar? Well, in contrast, and that's the important difference, in contrast to income and corporation tax cases, we have potentially three states which are involved into a cross-border cross-border case. We have the source country of the property. So where the property is located, let's say it is a house somewhere in faraway town. This house now passes over to a new owner by inheritance, for example. Now, there will also be a worldwide taxation in the country, in the residence country of the previous owner, of the deceased person or of the donor. Now, there is also another person involved. That's the acquirer, the person who gets it, and that person might also live in a different residence country. So we have now three countries in play: the source country of the property, the residence country of the deceased or of the donor, and we have the residence country of the acquirer. So if only two states are involved, there is a kind of a gap in the protection against double taxation, and this makes the whole thing more complex. So the situation for income or corporation tax was usually we just had source country and residence country. Now we have two residence countries potentially, and that complicates the situation. A DTT model for inheritance tax will have to develop, therefore, a more complex approach than an income tax treaty. Here, we need additional rules which also exclude the double taxation between the two residence countries. And that explains why the rules of a double taxation treaty for income tax cannot simply be extended to inheritance tax, but why separate additional rules are needed to cope with the double taxation problem in the field of inheritance tax. So we need special additional rules in a DTT, or even a special additional separate double taxation treaty for inheritance tax problems. That should be kept in mind. And that explains why the OECD has developed one model tax treaty for income and corporation tax only, and then additionally a very short own additional model convention for inheritance tax treaties. Yeah. And by the way, now we have an overview about that three-country constellation. This is, in theory, the simple constellation of double taxation which can happen. Naturally, this structure can easily even evolve into a more complex one, because there might be one or two persons involved having more than one residence, or it might be that more than one country regards the property as related to its own territory. For example, if the property in question is a claim for money which is directed against a citizen of state A, held by a permanent establishment in state B, and secured by a mortgage on a real estate property in state C, then all the three states could regard themselves with a certain justification as the source state of that claim. Okay, so rather difficult. Good. Now let's turn over to the next step. If there is now a double taxation in such a complex surroundings, then you know there are principally two methods which can be imagined as a measure to solve the double taxation problem, either the exemption method or the credit method. The OECD model for inheritance tax still contains both of these methods, but we have already said in the first chapters of this lecture that nowadays a state will usually not apply the exemption method in the field of inheritance tax, because that would enable the taxpayers in a way which is too simple to avoid inheritance tax completely or lower it in an unjustified way. So the favorite of all reasonably acting states will be the credit method in the field of inheritance tax. Otherwise, tax-saving models would be too simple. If you want to remember why, take into account, or look back into the first lectures, just to remind you of that. It would be simple if I have 1 million cash and I feel that death is coming, or I want to prepare a donation. I might say, okay, let's use this 1 million to invest it into a house in Faroestan. And now, if Faroestan has a tax rate of 10% and exemption method is granted, then I get away with paying 10% only on the value of 1 million, which changes owner when I die. And my heir can then sell the house again for 1 million or a bit more or a bit less, and probably saved an enormous amount of money due to the exemption method. And that simply can't be. That's too easy. So one will always prefer nowadays the credit method, especially in cases where, like today, capital can always be freely moved. Now we have, when we look to the credit method, a very specific problem. We have again, this, and this, 3 countries involved. So a double taxation can only be fully avoided if not only the tax of the source country is credited, but also the country of the one residence country credits the tax of the other one. And now there's a question, which country should get prevalence? So does the country of the deceased credit the tax demanded by the country of the acquirer, or the other way around? Which country should get precedence? And why is this important at all? You know that in the end, when you have the credit method, you always end up with the higher tax rate or the higher tax burden of the both countries involved. That should here be the same. Highest tax burden of the 3 countries involved should be what comes out. But what happens if the sequence of crediting is not fixed? Well, let's have a look. A property of 100,000 shall be passed on by inheritance. Now, the source country shall have a tax rate of 20%. The country of the deceased is state B and has a tax rate of 50%, and the country of the acquirer has a tax rate of 60%, state C. Now, let us imagine that state B taxes first and then state C levies its tax in the next step. In that case, the result shall be state A takes 20%, 20,000. State B then says, now it's my turn. I claim 50%, that is 50,000, but I credit naturally under the credit method the state in the source, the tax in the source state. So my claim is only 30,000 additional taxes, so only the surplus of my claim over the claim of state A. Now state C comes as the last in turn and says, okay, I want to have 60% paid. That's 60,000, but I credit first the tax paid in the source state, and secondly, the tax paid to state B. So the overall tax credit will be 50,000. What's left over for me, state C, is only 10,000. Let us now change the priority. What happens if state C has the right to claim taxes first, so before state B gets the opportunity? State A, again, the source country, begins and opens the fight with 20%, that's 20,000. Now state C says, okay, my claim is 60%, I want to have 60,000. I credit the source country tax, so I get 40,000. State B then comes into play and says, well, my tax claim is 50,000, but I see you already paid 20,000 in A and 40,000 in C, so that's enough. So there is a 0 tax remaining in this constellation for state B. Now you see, the overall result in both cases is the same. Taxpayer goes away with 60,000 total tax burden. Highest tax rate is what counts. But here, different amount goes to different states. And now, what happens if the 2 states do not agree on the sequence in which they have a right to tax? In that case, you get surprises. State A takes 20,000. Now, state B says, okay, now it's my turn. I say 50% should go to me. 20,000 has already been taxed. 30,000 is what you have to pay to me. And I don't give any credit for state C because state C is only the next in turn. State C must credit my tax, not the other way around. State C now says, no, state B is wrong. I am the second one in line, and so I compute my tax 60,000, and I grant you a tax credit for the tax in the source state, 20,000, but not for tax is from state B, because my idea is state B should be the next one and should credit state A tax and my state tax. And so state C also takes 40,000. In that case, you have a overall tax burden which explodes and could even end up with more than 100% in the end. Although all the states involved agree on there should be no double taxation, but you have now this effect that everybody says, yeah, the credit should be not, it's not me who is obliged to grant that tax credit. So what you absolutely need here is a general agreement who has to tax first and who has to give a credit for all the taxes levied before in the sequence. The OECD Model Convention for Inheritance Tax sees the problem as follows. They say the state of residence of the deceased or the state of the donor, so where the property is first and then is given away, gets the first claim to levy a tax after the source state, naturally. The country of residence of the acquirer has to credit this tax too. The reason behind that idea is, well, the country of the deceased was unlimited tax liable for the whole worldwide property. But now the deceased afterwards will be gone. So this moment here is the last possibility ever for the state of residence of the deceased to tax this property. Afterwards, it will be gone for eternity and end up in the worldwide property and the unlimited tax liability of state C, so state of the acquirer. And so they said, well, state of the deceased now has the last opportunity ever, so they, well, let's be polite, give them this opportunity. The state of the acquirer will have to credit more taxes, but then in the future they have unlimited access to that worldwide property, which now belongs to the acquirer. So being more generous now is something which they can afford because they get huge opportunities for the future. And that is why the state of the deceased gets the priority over the taxation rights of the state of the acquirer. Yes. So we end up with the following sequence. The first right to tax under the credit method has, as always, the source country. Then, second in line is the residence country of the deceased, which then credits the tax from the source country, but nothing else. And the third and last state in line is the state of the acquirer, which credits the taxes levied by the first two states. So in the end, you have everything credited and you end up with a single taxation on the highest level in one of the three states. Now this confusion is avoided. You have now a clear sequence of events and a clear sequence of taxation rights. Naturally, what happens if the state of acquirer is the source state? Then they have, as the source state, the first right to tax certain properties. That's clear. Yeah? But wherever a state comes into play as state of residence, then this sequence is the decisive one. Okay. Now the only thing which the OECD still had to do is, or was, to transform this three-step approach of taxation rights into an adequate legal text. They did this again by an article on how double taxation should be avoided. There are only few double taxation treaties of Germany, and I could give you an example from the treaty between Germany and Denmark. There you can see that in the articles 25 to 28. We can have a look into that. It's again my translation for reasons of copyright. So let's have a look into selected German double taxation treaties on inheritance tax. And there is first in the double taxation treaty Germany-Denmark, the description of the agreement, objectives. By the way, Germany-Denmark covers income tax, corporation tax, and in different sections also specific additional rules on inheritance tax. That is what you can see here, Article 2, the objective scope of the treaty. This agreement applies for the following taxes. Section 3 applies for taxes on estates and inheritances and gift taxes. And then we end up with the Article 4. The resident of one of the contracting states is explicitly defined, and it's explicitly given a different definition for the purposes of taxes on estates and so on. But there is no effective difference here, especially when we end up with the double residence. The tiebreaker rules are for income tax and corporation tax and inheritance tax the same. Okay, then when it comes to the section on inheritance tax, then you have here Article 25. There is the source state tax definition. So, under which circumstances does a state, Germany or Denmark, have the first right to tax under because they are the source state? 25.1. Immovable property, which is part of an estate, may be taxed by the state where it is located. So that's clear. A source state can only be determined if you have a clear connection to a source state, and a clear connection is always given with immovable property. So it's clear here we can determine a clear source state, and so immovable property, the source state can tax. Movable property has no clear connection to a specific state, because here you again have the problem. If I fear that death is coming, I can shift all my cash, my jewels, my cars to another state, and afterwards I can bring them back. There is no clear fixed connection between movable property and a given state. So only in very few cases you can say that movable property has, under the perspective of inheritance tax, a clear source state. And these cases are 25, paragraph 2. Movable property of an enterprise, which is part of the estate, so of an inheritance or of a donation, can be taxed if there is a permanent establishment in the state. So a permanent establishment also has a clear source state under these rules. And 25.3 says all other property can only be taxed in the state of residence of the taxpayer, but then with the important restriction, as far as Article 26 does not say otherwise, and the surprise will be Article 26 nearly always says otherwise, because Article 26 regulates the taxation rights of a state of residence. Now, after we went through Article 25 and had our first step, source state taxation, the next thing we need to look for is the taxation by the state of residence of the deceased or of the donor. Now, the traditional approach for the avoidance of double taxation in a DTT is there is an article which says either the person in question lives in Germany or lives in Denmark, and so there is always one paragraph, the treatment by Denmark or the treatment by Germany. Now, what we are looking for is the rules which apply if the taxpayer who was the deceased was resident, let's say, in Germany. So Article 26(1) says if the deceased at the time of death was resident in Germany, then Germany will credit only, I add that now, only the tax which is paid in Denmark, because Denmark is the source state. Only the taxes paid in Denmark under Article 25. Now what happens if the deceased was resident in Denmark? Well, then we also should say Denmark is then the second in line, can tax everything, but Denmark has only to credit the taxes where Germany was the source state then. That is 26(2). Now, what happens after we had looked to the deceased or the donor? Well, then as the third step, the state of residence of the acquirer can tax everything. And this must be looked for again in the article paragraph which refers to Germany or Denmark. So here 26(1) letter B, if the acquirer at the time of death was resident in Germany, then the Federal Republic of Germany, acquirer is the third in line, state of the acquirer is the third in the sequence. So what comes first is the source state claim, then the state of residence of the donor claim, and then our case here, then the Federal Republic of Germany may tax the complete acquired property and will credit, according to the rules of German law on the crediting of foreign taxes, the taxes which were paid in Denmark for all property for which Germany was not the source state under 25. Now, if the acquirer lives in Denmark, the same applies. But then you find it in the Denmark half of the Article 26. If the acquirer was at the time of death in Denmark, then Denmark credits everything, every German tax, apart from the taxes where Denmark is the source state, because then Denmark has the first right to tax and doesn't need to tax to credit German tax. Now there is even the clarification that the tax credit does not or even must not be higher than the tax which the state of residence which applies the credit method wants to take for himself or for itself. Okay. So the rules which we have here just show us in a relatively confused way exactly the sequence which we established before. Source state is always the first who can raise a tax claim and doesn't need to credit. Source state, under the DTT, you are source state for the things mentioned in Article 25. Immovable property and a permanent establishment located in your country. All the rest, there is no clear source state. Then second is the state of residence of the deceased, can tax everything and credits the source state tax. And then third in line, the state of the acquirer comes, taxes everything again, and then credits everything which the first two states have levied. So very simple. So when it comes to a testing scheme for double taxation treaty cases, you can again orientate yourself on the basic testing structure, which you know already from income tax DTTs, but now you should modify it a bit. First, the personal status of the taxpayer, the determination of the residence country. The modification is here not only one taxpayer is relevant, but two people are involved, the deceased and the heir, or the donor and the donee. So you have to determine the residence country under Article 4 for both of them. Then the usual testing sequence for each event or each transaction in income tax is what can the source state do and how does the residence country react. Here we have a modification. What can the source country of the property do? Article 25. And then how do the residence countries of the two people involved will react according to the standard sequence of taxation rights which we established. Okay. So let's think about example cases to illustrate that. Let's say Donald Dyer from Denmark dies and he leaves behind the following property: a house in Denmark with a market value of 400,000 euro, a house in Germany with a market value of 600,000 euro, a business which has a PE in Germany with a value of 500,000 and a PE in Denmark with a value of 1.5 million. And the heir of all that is Herbert Harritz from Hamburg in Germany. Now, how would the rules of the DTT Germany-Denmark demand for such a case? That should be something where we should take a look on. Okay, so first we will have to look for the residence of the people involved. So this will first be Donald Dyer. And we will have to look to Article 4 and probably Article 4.1, but there were letters, and so we should look that up to find the right one. So as we see here, the right letter in 4.1 of the Double Taxation Treaty is letter B. For the purpose of taxes on estates, inheritances, and donations, a person who is taxed because of an estate or donation under the law of state because of residence, habitual abode, and so on is resident there. So resident is a person where the unlimited tax liability refers to that person, evidently. And that seems to be the case concerning Donald in Denmark. So letter B, because Donald's estate will be taxed in Denmark according to unlimited tax liability. That's merely an assumption because we don't know the Danish law. Now the second person involved is the residence of Herbert Harritz we should clearly say resident in Denmark. See article. So the same, we should clearly say Herbert Harritz is resident in Germany. See article 4.1 letter B, because Herbert is subject to unlimited tax liability in Germany. And here we can even give the reference, see paragraph 2, subparagraph or section 1, sentence 2, letter A. Or that was no. Was it letter A or number 1? And that makes me a bit, oh my God, that makes me feel a bit uncertain, so we should look it up. And yes, indeed, it seems to work. It was indeed 2-1 sentence to letter A, natural persons who have residence in the inlet. So we are all right with that and can confirm that and write it down. Sentence 2, letter A. Now, after the residence section, let's go to the events. Now, events is here the property involved. So, property rules. Let's call it property rules if you don't have any other idea. The house in Denmark. The house in Denmark. Now, it should be clear that this house can be taxed in Denmark. Because Denmark is a source state. That's clear. Definitively, Denmark is here the state of source. Sorry, that was wrong. Definitively the source state. Now the only thing which we have to look up is if the question or the fact that Denmark counts as source state has been explicitly written down, or if it was regarded as superfluous. So let's look if Article 25 mentions this. If not, it would automatically follow from the second step that Denmark, as the state of residence of the deceased person, can tax everything. So we would have to look up now what the Double Taxation Treaty says in 25. And here we see Article 25.1, a movable property which is part of an estate by one person, by a person resident in one state and located in the other state, may be taxed by the other state. So if a house in Denmark is held by a German, then 25.1 would apply. If a Danish house is held by a Danish person, a Danish resident, then 25.1 does not apply. It does not mention that situation. 25.2, no. 25.3, all other property which is part of an estate or a donation of a person resident in a contracting state may only be taxed in this state. That applies to our Denmark case. So 25.1, not the Danish house. 25.3, owned by a Danish person. So we should make a note, not Article 25.1, not Article 25.3. DTT Germany, Denmark says this. Yeah, so now we have to talk about the avoidance of double taxation. Well, the first thing would be Denmark is, as the state of residence of the deceased, would get a right to credit, an obligation to credit and then tax first. So credit obligation for Denmark, and there is none because Denmark cannot be obliged to credit Danish and only Danish taxes. Now the next state in line is the state of residence of the heir, how it inherits. So we need to ask if Germany needs to credit the Danish tax, and again this will be found in Article 26. You remember that in that double taxation article we have the standard structure. First, if the country of residence of the person involved is Germany or if it's Denmark. We need Germany here. So if the deceased at the time of his death was resident in Germany, no, that's not our case. Then if the acquirer at the time of death of the deceased, blah, blah, was resident in Germany, then Germany can tax everything, but will credit, according to the rules of German law, the taxes which were paid in Denmark for all property which is not Germany, sourced in Germany. And that is the case with our Danish house. So Germany must credit under 26(1)(b). Germany must credit the Danish tax under Article 26(1) letter B of the DTT Germany Denmark. Then we have the second event, so let's renumber that a bit. Seems to be better this way. 211 2. So we have 21 22, the house in Germany. 211. What about Germany? Can Germany tax? That's the question here, and we will have to answer that nice question. So let us think about that. This house can be taxed in Germany because it is located in Germany. And this is now the case of 25(1), because in this case the former owner was resident in Denmark and the house was situated in the other contracting state. So let's have a look. Indeed, here you have it, immovable property which is part of an estate or a donation by a person resident in Denmark, the one contracting state, and located in the other contracting state, that is Germany, can be taxed by the other state, that is Germany. So let us think about now for credit obligations, so avoidance of double taxation. Do we have a credit obligation for Denmark? And the answer is, well, Germany is the source state, Denmark is the second in line and has to credit. Yes, we have a credit obligation for Denmark, therefore see Article 26, and I believe it was paragraph 2 there, and we have to look it through now and to look for the appropriate letter which tells us that Denmark has to credit the German tax for the house. So in case of Denmark, double taxation has to be avoided as follows. If the deceased at the time of death was resident in Denmark, yes, that is our case. So letter A is our case. Then Denmark credits, in accordance with the rules of Danish law, to the tax payable in Denmark, the tax and only the tax which was paid in Germany for the property situated in Germany. And we have property situated in Germany here, so Denmark has to credit the German tax here. So letter A, Denmark must credit the German tax. B, credit obligations for Germany as the state of residence of the acquirer, and there is none because Germany does not need to tax to credit German tax to German tax and not the Danish tax to German tax, because Germany was the state of residence, so it has a full claim to its residence, so its source state can thing. 2.3. The PE in Germany Well, this PE in Germany may be taxed in Germany because Germany is the source country. And that was Article 25.1 because that was property held by a Danish resident in Germany. That was a cross-border case. Then let's call it 3A. 3A. Credit obligations, so avoidance of double taxation. Denmark has to credit the German tax. That was again Article 2, letter A, because Germany is source country of that permanent establishment. By the way, that was 25.1 letter B. No credit obligations for Germany here. Okay, how does it go on? Now we have to think about the PE in Denmark. And the rule is, first, Denmark is the source country, and Denmark can tax under Article 25.3. That was 25.3 because 25.1 was only for cross-border PEs. All the rest, for example, all the property of a Danish deceased in Denmark goes to Denmark in the first step. So there was no problem there. And then Germany has to credit the Danish tax. That was under Article 26.1. And let's look for the letter again. So, Federal Republic of Germany, if the deceased at the time of death and so on was resident in Germany, that's not the case. But if the acquirer was at the time of death of the deceased was resident in Germany, then Germany can tax everything but credits the Danish tax on everything which is not in Germany, so also on the Danish PE. So 26.1b. So that was letter B. Okay, now that case is with regard to what the double taxation treaty says, practically completely done. And the only thing we can check for reasons of certainty is the personal scope of application, or so, if there's something in it which we have overlooked. And we could now look to the treatment of this case under German law, and let's do the one thing after the other. Let's have first a look to the personal scope of application of the treaty. So I must admit I forgot to check this, but it should always be checked in complicated cases like these here. If the double taxation treaty is really applicable, and section 3 says the double taxation treaty Germany-Denmark is applicable to inheritance tax cases in case of estates or inheritance taxes if the deceased was at the time of death resident in one of the contracting states. That was the case in Denmark. Or in case of donations, if the donor was resident in one of the contracting states. So what is highly interesting is, what comes out here is the whole double taxation treaty Germany-Denmark would not be applicable if the dying person had been resident in Angola also, and then Germany and Denmark would only come into play as countries of residence of the taxpayer who inherits. So this just as an additional remark. Now let's turn to the situation under national law as far as we can say something on that. So just for your better information, not demanded by the case, because the question just is simply what are the rules of the double taxation treaty Germany-Denmark for this case, and national legislation. Here we would say the event is a taxable event because inheritance is acquisition on grounds of death. I hope you remember that the rules. 1 number 1 plus 3 1 number 1 of the Inheritance Tax Act in Germany. It is unlimited tax liability which applies. We can see that in 2.1 sentence 2 letter A, because the heir is resident in the inland. Now we would have to talk about the arisal of the tax. Paragraph 9, 1 number 1, the day of death. So that's relevant. And the tax base would be under 10.1 sentences 1 and 2, the complete enrichment of the acquirer, as far as it is not tax free. So that would be one after another. The house in Denmark, 400,000 euro. And now we would find out that we can't say more because some details would be missing here. Some of the details which are missing is it a family home? So would the exemption under 13.4c apply? Probably not, because heir lives in Germany and will probably not move in. And we don't know if the house really was inhabited by Donald Dyer before he died. So 90% valuation under paragraph 13d of the German Inheritance Tax Act. There we would also need additional data, because it's not clear if it's let to tenants. Furthermore, the house in Germany, same problems. And the business PE in Germany exemption would be possible according to paragraph 13a, 13b, 13c of the Inheritance Tax Act. The same applies for the Danish PE under the conditions laid down in the Erbschaftssteuergesetz. So also here we don't have additional data, which shows clearly that if a case was only designed for purposes of inheritance tax, and if the question is only please apply the rules for the double taxation treaty, that then it makes no sense to try to do more. So having a look to the question or the task always pays naturally. Okay, here we have yet another case. Dagobert Dussel from Düsseldorf dies, and Dagobert leaves behind a business with a PE in Germany, a PE in Denmark, and a PE in Angola. And furthermore, a house in Germany, a house in Denmark, and a house in South Africa. The heir is Fred Faraway, who does neither live in Germany nor live in Denmark, but in Farawayston. And the question is naturally again, how is that case to be treated under the rules of the Double Taxation Treaty? And you know, the only thing we can hope for is good luck here. Okay, so we have to talk now first about the residence of the persons. Number A is Dagobert Dussel or Dussel from Düsseldorf is, sorry, that automatic list is resident of Germany under Article 4, 1, letter B, because his estate is there taxed under the rules of unlimited tax liability. And Fred Faraway is neither resident in Germany nor in Denmark under the DTT Germany, Denmark, see Article 4, 1, letter B. Good. Now, the personal scope of application does now become relevant, because we have here indeed a case where not everything happens within the two states. So the question is, did the two states agree on the application of the treaty or not? That was Article 2.4 of the DTT. And it said, if we remember that correctly, that the treaty is applicable if the deceased was resident in one of the two states. Here the case, here that is the case. See above. We should nevertheless check this again by having a look at the relevant passage of the Double Taxation Treaty, just to be on the safe side, naturally. Yeah, here it is, 2.4, paragraph B, no, letter B, and then double letter AA. The deceased was resident in Düsseldorf. So that's clear, the treaty applies. It is not requested that the heir was resident in one of the two states. So that was, to make it more precise, letter B, AA of the Double Taxation Treaty. It does not matter that the heir does not live in one of the two states. So number 3, we come to the distribution of taxation rights. The usual questions always: source country and obligations of the residence countries. Well, the business PE in Germany. Well, what does the treaty say concerning the source country taxation? Here we have a German resident leaving behind a German PE. That was in Article 25. It should be clear Germany is, in case of a PE, the source country, but Article 25.3 was that. Germany is source country and has the only right to tax. Now, what does that mean for Denmark and for credit obligations? Avoidance of double taxation. Now let's look what happens if Denmark, well, can Denmark have any right here? The heir lives in faraway Stan, so it's difficult to imagine that Denmark could have any claim to the worldwide property taxation with regard to Fred Faraway. So Article 26 should not be applicable at all to Denmark in that case. Let's have a look if that's true. So in case of Denmark, there is avoidance of double taxation only in the following cases. If the deceased at the time of death was resident in Denmark, no, he was not. And if the acquirer at the time of death of the deceased was resident in Denmark, no, he was not. So there is no authority or no right for Denmark, no obligation for Denmark to avoid double taxation. But there is also no potential claim for Denmark to claim any tax on the business in Germany under 25.3. So Denmark is completely out here. Article 26 does not apply for Denmark here. So no taxation right for Denmark at all, which does not surprise because there is no unlimited tax liability for our case here in Denmark at all. 3, 1, let's call it B, the PE in Denmark. Now, Article 25.1 should say that would be expectable that Denmark may tax the Danish PE because Denmark is the source country. And then Article 26.1 should say that Germany should avoid double taxation by crediting the Danish tax on the PE to the German tax on the PE. So we would have to check that if that's true. So that was the permanent establishment, which is movable property, which is part of business property, can be taxed in that other state. So Denmark can tax. And now let's look to the avoidance of double taxation. If the deceased at the time of his death was in Germany, then Germany will credit the tax which is paid in Denmark as source state 25.102. So that seems to be our constellation here. And now, just for the sake of completeness, the PE in Angola. Now, Article 25.3 says, 25.1 says, real estate property in Denmark can be taxed by Denmark if the deceased lived in Germany. 25.2, a business in Denmark can be taxed by Denmark if it's located in Denmark. Now, Angola is not in Denmark, so 25.3, this property can only be taxed by Germany. And we have no obligation for Denmark to avoid. Is it Denmark or Denmark? Oh my God, Denmark. Oh. No obligation for Denmark to avoid double taxation, but also no right to tax because there is no unlimited tax liability and so. Yeah, so that's it. And now 3-2, the house in Germany. Germany can tax the house of a German under Article 25.3. Denmark is not involved. Article 26 does not apply. As before, there is no reason why Denmark could take a tax, and so Article 25.3 says only Germany can levy a tax, and then 26 says Denmark is completely out because we do not have the case that the taxpayer lived in Denmark. So then we have the house in Denmark. Denmark may tax under Article 25.1, and Germany must credit the Danish tax. That was Article 26.1, Germany. And if the deceased lived in Germany, so letter A. And then we have the house in South Africa. Here, only Germany may tax, Article 25.3. All the things which are not mentioned before can be in the relationship Germany-Denmark, only be taxed by Germany. No obligations for Denmark to credit, because no unlimited tax liability in Denmark. See Article 26, so that case is closed. By the way, this constellation would be highly interesting in cases where some deceased person had a double residence, because that double residence is reduced by the tiebreaker rules in the double taxation treaty only to a single residence country. So that then indeed Denmark would lose taxation rights. Now, what else is naturally clearly to remark? Naturally, the treaty Germany-Denmark does not affect the taxation rights of faraway Eastern, Angola, or South Africa. That's clear. So the taxes which are levied there, if they have to be credited, by whom and in how far, that has to be then determined under national law, in that case of Germany. Okay, that's the end of this case. Now let us focus a bit on the source country problem. So if there is no clear source country which could be identified, then what shall we do? And this case that we do not have a clear connection and a clear and compelling connection to one country is always the case when you have movable property. It makes no sense to attribute movable property to a fixed location, because in preparation of a donation or in preparation of an inheritance which can be foreseen, the people would go and shift the movable property to the most convenient state of location. So movable property, that makes no sense. It could too easily be moved to another case, so other country, so we would have no convincing connection between movable property and a certain country in most cases. So you have to decide more or less arbitrarily, but with international consensus, to which country the movable property of a person has to be attributed. And here, the states usually say we attribute movable property as far as there is no clear and convincing connection to a certain state, to the state where the deceased or the donor lived. So movable property, or property without a clear state connection, without a clear and stable connection to a source state will always be attributed to the country of residence or to the residence of the previous owner. So it is located at the moment where the owner lives. Now, if that is donated or so, then its source is in the country of residence of the owner. Now, that leads to an interesting consequence concerning the status of that property, because if the deceased lived abroad, then his movable property belonged to the foreign resident, so it is foreign property. And so it can qualify for a tax credit for foreign property. Now, if the deceased, however, lived in the inland, then all his movable property is inland property, because it will be attributed to the residence of the deceased, and the resident was in the inland. Now, for inland property, one usually does not accept foreign taxation. One sees oneself as the source state and claims the primary right to taxation, and says a credit must be given by the others. So accordingly, inland property will not enable to get a tax credit. That explains why, depending on where the dying person or the donor of a gift lived, depending on that, you will get a tax credit for the movable property or you will not. So the basic thought behind that is clear. This even explains that strange distinction in paragraph 21 Inheritance Tax Act in Germany, where also it is said you get a credit on foreign property depending, and the extent depends on where the previous owner lived. We should take a look to that rule in the German law to make ourselves familiar with that. So here you can see that if an acquirer is taxed with foreign property by a foreign state with an inheritance tax, then in case of 2.1 number 1, if a double taxation treaty is not applicable, the foreign inheritance tax can be credited against the German inheritance tax, which is due for that foreign property. Now, the second paragraph then defines as foreign property is regarded, and here you see exactly what we spoke about before. There is a distinction. If the deceased was inhabitant of the inland at the time of his death, then remember, then all movable property will be attributed, or all property where there is, from the perspective of the law, no clear and strict connection to the inland, then only the assets, no, all the movable property will be attributed to the residence of the deceased. So all the movable, the unclear property will be regarded in that case as inland property. So you will only get a credit for those assets which, from the perspective of the law, the German law, are strictly and permanently related to a foreign country. So here you can see, in accordance with that concept, if the deceased was in the inland, then you get a credit only for taxes on the assets named in paragraph 121 of the valuation law, the ones which are clearly attributable to one country. Whereas if the deceased lived abroad, then all the unclear property was also attributed to the residence country of the deceased. So everything is then foreign property, which is not explicitly German-based property under the rules of 121 Bewertungsgesetz. So that sounds a bit strange, but that is explicable from that basic concept. All the property where there is no clear connection to a source state is attributed to the country of residence of the taxpayer, of the deceased. By the way, 121 Bewertungsgesetz has a bit of a longer list than the list of the Double Taxation Treaty. So also major participations would here be regarded as sourced in the country of the company, but the basic problem and concept is the same. So this basic decision also was what was underlying the Article 26. Here also you have that distinction. If the deceased lived in Denmark, then Germany credits all Danish taxes. The idea is if the deceased lived in Denmark, then everything, the Danish property and all the unclearly located property, was fictitiously regarded as property in the country of residence of the deceased. So then all the property, apart from the clearly German one, is foreign property, so Germany credits for everything. On the other hand, if the deceased was resident in Germany, then all his German property and all the unclearly located property is qualified as German. So then only the Danish property would be foreign property, and only for this you have then a credit obligation. 21 Inheritance Tax Act has the same principles. And if that is the case, one might ask why, under such circumstances, a double taxation treaty is still necessary. Indeed, very often, the German state at least doesn't conclude a double taxation treaty. But, surprise, 21 of the Inheritance Tax Act is not sufficient to avoid double taxation treaties. Double taxation, sorry. The answer is that if you have no double taxation treaty, there might be constellations where the national rules do not remove all possibilities of a double taxation. For example, it might be that somebody is regarded as inhabitant of the inland by Germany. That happens if you have at least one residence in the inland. Now imagine another state has exactly the same rules in force. If you have also one residence there, then they will also regard the deceased as resident there. That will lead to the consequences that both states will say under their domestic rules that the unclear property, the one without a clear fixed location, is claimed by them as inland property, and they refuse to credit foreign taxes on it. And so then you have an amount of property or part of your property where no unilateral removal of double taxation takes place. So the taxes could even go higher than 100% for that unclear location property in case where you have, for example, a double residence. That might happen, and cases like these have already happened in practice in former times. So especially in cases where you have double residence, a double taxation treaty is highly important. However, you do not always have that. Germany has at the moment 4 or 5. Unfortunately, under the present rules of the EU treaties, there is no obligation of the member states to conclude double taxation treaties on inheritance taxes at all. That is highly problematic because more and more cross-border relations bring along the problem that more and more cross-border inheritances are going to happen, and there will be more and more cases where we have movable property claimed by 2 states as inland property, or similar constellations where there is no double taxation treaty, double taxation treaty, or where there is no unilateral avoidance of double taxation granted. So it might happen that the problem can't be avoided. Good. And unfortunately, according to the jurisdiction of the ECJ, if each member state practices a system which makes sense, then you can't force one of the member states to back down from their taxation claim until there is a common harmonized rule or something like that on the EU level, because in the fields where the member states still are sovereign, where they still can write their laws on their own, they can also freely determine to which constellations and which cases their laws apply, and when not they want to take back their claims by a unilateral renunciation on tax revenue. So there's nothing in the field what might help there if you make a mistake and a case constellation arises where unilateral measures don't help you against double taxation, and where there is also no double taxation treaty applicable to this tax. Well, we have a third problem left over. That was the credit limit problem. The basic idea was that a state does never credit more foreign tax on an item than it claims itself for this item. So the credit limit means that a state is willing to reduce its tax claim to zero by crediting foreign tax against the own tax liability, but they are not willing to go into the negative. So to grant refunds or to lower other tax claims due to your overpayment in the other state. Yeah, so you always have to compare what do I pay for that item in the other state and what does my own state demand for that item. And the minimum of both is the tax credit which you get. So the credit limit is the tax amount which your own state claims. In many cases, one doesn't, just for reasons of simplification, doesn't view the individual single items, but all foreign property from a given state together. But then the logic is the same. What does the foreign state claim for that foreign based property, and what does my own state claim for that specific property? So, to have an example, if a foreign state taxes an item of 100,000 with 15%, then you pay 15,000 there. If your own state of residence wants 20%, that's 20,000. So the credit limit is 20,000. You can credit the foreign tax against it, so only 5,000 remain payable in your state of residence. When you have, again, 15%, but now your own state only claims 12%, then a reduction which you can claim for double taxation avoidance is only 12,000, because your own state only wants to take 12,000. They go down by tax credit up to zero, down to zero, but not into the negative. So that credit limit is simply the amount of the home state tax on the foreign asset. So that's the basic principle. Now, where is the problem? Because, well, we know that my state here, last time, it took 20%. Well, and here it took 12%. So what was the problem? Well, the problem is that sometimes the tax which your resident state claims for a specific foreign item is not easy to be determined, because you have a worldwide property constituted of thousands of individual items. Some items have special valuation rules and are valued differently in different states, and there might be personal allowances granted on the overall or on the total of your worldwide property. Then the question is how much of the personal allowance refers to what, and that makes things complicated. So you need rules how you can conclude which part of your total final tax in the end, which comes out from the computer program, which assesses you, not assassinates you, but assesses you. How much of that refers to your personal tax on that specific foreign item? And there are different approaches. Yeah, let's have a look. The first is you just look to the total tax which is due in your state of residence, and then you make a conclusion based on the proportion of the foreign items in relation to all items. So, for example, let's say asset number one is a foreign asset, then you have also two other assets, 2 and 3. Then you have a total value of all assets. You deduct personal allowances. You have a final total taxable amount. You take it times your applicable tax rate and you get your tax. Your tax and your whole inheritance. Now, if I want to compute the amount of tax which has to do with the foreign asset, here the idea would be I look to the value of the foreign asset, number one, and to the percentage which that is of the total value of all assets. So the proportion or the ratio asset number one in relation to all assets together, that is that fraction of my overall tax which refers to the foreign asset. That's the idea. So an example would read as follows. You have a foreign asset 100,000, you have inland assets of 500,000, so you have a total value of all assets 600,000. Personal allowance 400,000 minus, final total taxable amount 200,000, tax rate 11%, 22,000. So the proportion of the foreign asset to the total value of all assets to all assets is 100,000 to 600,000. That is 1/6. So 1/6 of 22,000 is seen as relating to the foreign asset number one, 3,666. So whatever you paid in the foreign country as foreign tax, you cannot lower your inland tax of 22,000 by more than 366 because all the rest is not paid for that foreign item. There might be variants of that solution, of that logic, because if you have not only positive assets but also liabilities, then the question is naturally, if I look to the proportion of the foreign asset, do I only measure the asset in relation to the total of all the positive assets, or do I compare the value of the foreign asset to the total of all positive and negative assets? And the difference can be shown by examples again. In the first approach, I only look to asset 1, 2, and 3 and leave out the liabilities. Then I get the percentage of the foreign asset in all the positive assets. And the approach number 2 would be I look to the proportion of the foreign asset in relation to the total value of everything. Examples would run as follows. If I look only to the positive parts, asset number 1, 100,000, asset number 2, 200,000, asset number 3, 300,000, liabilities 70,000 together. So altogether 530,000. Personal allowance deducted 400,000, total taxable amount 130,000, tax 14,300. Now all the positives is 600,000 and 100,000 is 1/6 of it. So 1/6 of the 14,300 would relate to the foreign thing. Now in the second approach, all positive minus negative assets, then I have 100,000 in relation to 530,000. That's approximately 18.8%. That leads usually to a higher tax credit because the percentage is higher, because here the number below is lower, so the divisor is lower. You might also, that is a different approach, compare the relation of the foreign asset to the final total taxable amount. So to the final tax base after the personal allowances and so on. That would be the value of the asset divided by the total taxable amount attributed to the tax. That would mean, in our case, we have a foreign asset, 100,000, we have inland assets of 500,000. Forget about the liabilities again, for reasons of simplification. We deduct 400,000, so we have a final total taxable amount of 200,000, 22,000. And now, surprise, 100,000 divided by 200,000 is 1/2. So we get a considerably higher amount of the overall tax, which is thought to be levied on the foreign property. You can even transform that approach into a nearly mathematically identical approach. That is, that you take the tax rate and apply it to the foreign property value. This is, in theory, in most cases, the same as the former formula. Yeah, all these different possible ways lead to different outcomes for the credit limit. That matters only naturally when the credit limit cuts off a bit of the foreign tax. So if it's lower than the tax which you paid abroad, in other cases it does not matter. But if we have credit limits of 1/6 of 2000, 22,000, or 1053 out of 23,000, or 1/2, then you get considerably different amounts. And if the foreign tax then is lower than one of these amounts, then a part of the potential tax credit is cut off. And so how you calculate has immediate monetary consequences. Because it matters if you can reduce your home state tax burden by only 3,666 or by 11,000 or by 10,000 or so. So if the foreign tax is 15,000, then that's a great difference. Now, in order to judge which of the formula is the best, it makes sense to think about the mathematical background of these different formulas. When, for example, you look to that traditional formula that the foreign asset is compared to the value of all assets and the personal allowances are left out of consideration, then that is the foreign asset divided by all assets times the tax. Now the tax can be replaced by tax rate times all assets minus personal allowances, so tax rate times tax base. That can be by the solution of that brackets be transformed into foreign assets divided by all assets, so the fraction, times the tax rate times all assets, minus same fraction times tax rate times personal allowances. That allows a simplification. Here, where the things are marked yellow, these can be eliminated against each other. So you have foreign asset minus times tax rate, and then minus a factor foreign asset by all assets times tax rate times personal allowances. And that shows us that in this case of the credit method, when this formula is applied, then you grant the tax credit in principle as foreign asset times tax rate, and then there is an additional factor which costs you a bit of your personal allowances. Tax rate times personal allowances is the tax saving effect of the personal allowances, and that is deducted times a factor. And that factor is the value of the foreign assets divided by all assets. So that factor means the more of your assets have been placed abroad, the more of your personal allowances will be, in a very cleverly hidden way, withdrawn. So if you, for example, invest all your foreign assets, all assets in a foreign country, nothing of your personal allowances will be effectively left over because they are indirectly revoked by cutting down the credit limit. Economically, that means the personal allowances are granted on foreign property where they can, in most cases, have no tax lowering effect, actually. And the European Court of Justice has already frequently ruled in the field of income tax that calculating the tax credit limit in that way violates the fundamental freedoms of EU law. It cannot be justified because it systematically leads to the effect that more and more percent of the personal allowance of a taxpayer is in a hidden way withdrawn or withheld, the more this taxpayer has made usage of his or her fundamental freedoms and invested abroad. And although that jurisdiction is at the moment only available for income tax cases, the mathematical logic is compelling here too. You can bring forward no convincing reason why the personal allowances shall be given in a way that their tax saving effect goes more and more down the more you have property invested abroad, because the basic idea of a personal allowance is to leave a certain amount of your inheritance tax-free for personal reasons. And now to grant such a personal allowance in a way that it has less and less effect the more you are a cross-border case. That cannot be convincingly justified. That has already been decided, and so that should also be done in the same way in the field of inheritance tax. So here that proportion of the assets method or proportionality method should also be regarded as forbidden. You would also here probably have to take refuge to the alternative method, that you either take the ratio between the foreign asset and the total final tax base after deduction of personal allowances, so a smaller tax base, or the basically equivalent formula tax rate times value of the foreign property. So in German national law, we have already seen that paragraph 21, the inheritance tax act, where we have a unilateral tax credit method. And there, surprisingly, it's not fully clear how the credit limit has to be computed at all. Because there, the rule is that the total German inheritance tax has to be apportioned to the foreign and the inland assets according to the ratio between the taxable, that is the liable to tax foreign property, and the total taxable property, including the foreign property. Now, the thing is that that term specifically used there for total taxable property in German, steuerpflichtiges Gesamtvermögen, is not used elsewhere in the text of the Erbschaftssteuergesetz, so that one can only guess how it has to be interpreted. Steuerpflichtiges Gesamtvermögen, total property, could mean total property before deduction of the personal allowances. But it could also, because it is called taxable total property, steuerpflichtiges Gesamtvermögen could also be interpreted as being the figure which comes out after deduction of the personal allowances. And then in the second case, it would be in line with what the European Court of Justice formula demands. Now, in all cases where the interpretation of a national law is unclear, judges are held by legal theory to assume that the legislator wanted to fulfill the obligations under EU law in the best way. So there is an interpretation method which says in cases of doubt, national law has to be interpreted in conformity with EU law, and that would recommend that the formula in 21 Aircraft Gesetz should be interpreted as foreign asset divided by the total tax base after deduction of the personal allowances times total German tax, or even more simple, tax rate times foreign assets value is credit limit. Now, I rather expect that the German tax authorities, if they do not clearly see the problem, stick to the other solutions, perhaps. I couldn't find a clear letter of the fiscal ministry. It probably exists somewhere, but I couldn't find it out. And even some relatively good commentaries do at least not widely discuss the matter. In the double taxation treaties of Germany, there is no rule at all concerning the credit limit determination, because there the double taxation treaties usually just say, oh, you have to grant a credit up to a credit limit according to the details which are laid down in the national law. So the problem there is not fixed. They just say, look into the national law, how the credit limit is determined there, and in accordance with these rules, it should also be calculated for the double taxation treaty purposes. So there we do also not get any solution of this specific problem. Okay, now you have got a very, I admit, lengthy overview about the specific problems in cross-border cases with inheritance tax. The next thing which should be due is exercise cases. But this is definitively a case for later and not for now. This was, I think, enough for today. Thank you for surviving or even watching this video. And I hope to see you again on the channel sooner or later. Goodbye.